Thanks for joining us here live in studio. I am Jonah Dew of the Banking Bros and the Money Multiplier. And today's video is all about a very frequently asked question in my role. What if I have a one-off expense coming up that I want to strategically use my policy to cover? Now, those one-off expenses can be anything when it comes to you and your financial goals. So I've helped folks navigate around new car purchases, around new home purchases, around investments, around crypto, around real estate purchases, so many things. But today's video is about college. Now, this is a real life scenario. However, we've removed the real client's name and any information that pertains to them and their policy to protect the wealthy. Now, the scenario is this. This client has a daughter that's about 10 years old now, and that will be going to school when she's 18. Now, the parent wants to make sure that the child's expenses and college expenses, university expenses are completely covered by their policy. And so what they've done is start a policy on this child, and they want to make sure that the expenses will be covered for all 4 years of school if the child decides to attend school and go to school. Now, disclaimer before we jump into the numbers. The cool thing about infinite banking, privatized banking, is that these policies are going to generate cash value year by year by year, over and over and over again, an ever continuing and increasing cash value. So just in case the child does not want to go to school and you put away all this money to pay for school and they say, no, we're not doing it, we're doing something else, whatever that might be, you don't lose the money. This episode is about those values, about the example, about seeing this real life scenario. So let's jump into the numbers. Okay, so in front of us, we have a policy that is set up for a premium deposit of $10,000 each year. So this is the parent deciding to start the policy on their 10-year-old daughter in the amount of $10,000 each year. So again, it's a female age 10. This is a standard policy through an insurance company, abbreviation AUL. Now, it's not about the company. We can use lots of different companies to accomplish this. This is just the example that they had. And their product is called Legacy 121. It is a $4,000 base, $6,000 paid up additions split for the first 8 years. The loans that they take out to pay for school are going to be starting to be repaid in the 9th year. And these are the non-guaranteed values from the policy illustration, meaning that we're including the dividend when we show you the cash values. So let's walk through a few years together. The first year of the policy, the child is age 10. There's a $10,000 policy premium deposit. That means that there's cash value available of $5,807, and if something were to happen to the child, the remaining family, the beneficiary, would get just over $1 million. Now, reminder, this is an isolated expense purchase of college. Now, can that $5,800 be used right now to pay for Christmas presents or birthday presents or vacations or debt? Absolutely it can. But the point of this exercise and example is to show you this isolated expense. So we're not going to use the money. Let's keep accumulating. Let's keep moving. The second year of the policy, $10,000 goes in. There's about $12,200 to use. And if something were to happen to the child, $1.1 million passes to the family. Of course, let's fast forward to year number 9. See, in year number 9, the child is now 18 years old. The start of their college career. And so the premium actually drops to $4,120. Now, we did this on purpose per the parent's recommendation. And here's why. See, they took $24,000 to pay for the first year of schooling for their child. And since they want to repay that loan, because what bank do you know that allows you to take a loan without a repayment coming back? That's right, none of them. So when we take loans, we're always going to repay the loan, and to make it seem for the parent that there was no difference in the bank balance or their pocket, they decided to drop their premium to $4,000 and repay the loan at a clip of $6,000 per year, which is exactly the same as $10,000 that they were putting in their policy premium deposit each year prior to that. So no change for them, no change on their monthly budget, no change on their monthly expenses. But now they've taken a loan and repaid the loan. So $24,000 comes out of this policy's cash value. That's why you see a drop in the cash value from year 8 to year 9. You still have some growth, so it's not a true $24,000 drop, but that's why you see a decrease. And the child is now in school, completely paid for. Now, that continues for the next 4 years. $24,000 each year goes to the child's school bill, $6,000 loan repayment coming from the parent with a $4,000 premium. It's the same $10,000 contribution out of their pocket, their net injection, $10,000 going into this policy. They're going to use their cash value all the way down to about $14,000 remaining. So that's at the end of year number 12, $14,000 remaining. Now again, let's stop. Could they use this $14,000 to do other things? Absolutely they could. Could they have used any of the cash values up to this point to do anything else that they wanted? Absolutely. But this is an isolated example, and so we're only going to use the money for school. Now, after school, we have not repaid all $96,000 that we took out to go to school. That's $24,000 4 times. We haven't repaid it all, but the child is now out of school. So the parent is now going to request of the child that they start to repay their own policy loans that they used to attend college. And that's why the repayment to self goes up to $15,000 for 4 years and then finishes with $12,000 to wrap up the loan. Now here's the fun part. Here's one of my favorite things to look at. If you isolate the cash value from the time that you started school, so this is year 9 of the policy, it's $62,349. And by the time the loan is completely repaid, so this is year 17 of the policy, the cash value is $119,000. I'm sorry. That's almost $60,000 of cash value growth over the exact amount of time that you went to school, completely paid for, and paid back the $96,000 that you took out of the policy. That is crazy that you still have that much growth while using the money. Now again, keep in mind, you can use cash value for anything. Using the cash value to grow the policy's cash value during a college career works, then why won't it work for anything else? Not to mention, there is a hefty sum that's going to the beneficiary, family, friends, church, or charity, just in case something happens to the child during that time. Now, here's one of my favorite parts. You add up all of those policy premium deposits, which is $150,000. And take a look at your cash value growth over the same 25 years that's illustrated on your screen. You'll notice that you made in that same 25 years about $70,000 plus while completely paying for your child's education, never having to take out a loan from Fannie Mae or Sallie Mae or whoever the May is these days, keeping control of your financing, keeping the money in your family, repaying that money back to your policy so it can be used again for the next child, for the grandchild, for retirement purposes. There's so much going on here. For today's episode, that's it. But keep in mind, I'm Jonah Dew. We are the Banking Bros with the Money Multiplier. We'll see you next time.